Hello everyone and welcome back to a new episode of TCU Talks.
We're so excited to have you here. We can't wait to get into things. It's going to be an awesome episode today.
We are going to be talking about the basics of investing.
This is a topic that I think a lot of people don't know how to get into. I think a lot of the times it's intimidating, it can be overwhelming, there's a lot of different things. So really, we're going to talk about just how to break it down into the base fundamentals. And then if you get interested in certain areas of that, you can dig more into that.
Absolutely. So when we first start by talking about why are you investing, I think there's so much stigma that when someone says, oh, I'm investing, they're like stocks and bonds and all this really complicated stuff. But everybody can invest for different reasons, and it doesn't need to be overly complicated. So first thing you want to determine is, why are you investing? Is it very, very long term? You're looking at retirement plan, something where you have a mark that you want to hit that will allow you to retire with a certain lifestyle? Or maybe it's for things that are a little shorter term. Maybe you're wanting to put money away to purchase your first home or upgrade your home or get into the next one. Maybe you've got young children and you want to have some money aside for them to go to school, or you're saving up for a wedding, a new car. There are so many things that we can invest for that doesn't need to be overly complicated. It's just putting money aside for those special occasions.
I think time horizons is probably one of the most important things when it comes to investing. If you have 30, 40 years, then you can assume more risk, or you can be riskier with your investments, because it doesn't matter if they go up and down, because in the long term, right, 30, 40 years of investing, you're probably going to come out on top. So thinking about how much time you have is a big thing. The next area that I think most people need to figure out is where to invest my money. That is a question we get all the time. Where should I put my money? Now, in terms of other areas, you have like real estate, you have business, you have a lot of different other areas. We're going to talk about putting your money into the markets. So investing your money into the market. So when it comes to investing, there's three main areas in Canada that people can invest their money. So I want to specify this as Canadian-based accounts. First, we'll talk about registered accounts. So you have something called an RRSP, and then you also have something called a tax-free savings account, okay, or a TFSA. Then you also have something called a non-registered account. That means it doesn't have the same rules and regulations as some of the registered accounts does, okay? So let's start with the tax-free savings account. This is literally the best gift Canada has ever given us.
Absolutely.
Okay? It has a lot of advantages if it's used properly. Okay. When you put money in, let's say you have $1,000 to invest. You put $1,000 into your tax-free savings account. You don't get any sort of tax deduction for doing so. Okay, you just put money into it. Then over time, as you contribute into it, there are certain limits. Okay, most people think it's about $5,500 per year, but if you've been around for a while since they've been created, then you can put in something like, at this time of the video, around 70-ish thousand, okay? But just talk to your accountant or see what in your taxes, how much you've contributed, how much room you have, okay? So you need to figure that out. And then the last thing that's probably the best part about it is when you pull money out,
you pay zero taxes.
Zero taxes, my favorite part, right? I think it's a great vehicle, if used properly, getting fueled for retirement. In my opinion, it should be called the tax-free retirement account, because so many people just use it like a savings account, right? They put money in, they pull it out for a vacation, right? They put money in and they take it out for a new boat, right? So a lot of people are not using it to its fullest ability. Now let's move on. Something called an RRSP, okay, or a registered retirement savings plan, okay? When you put money in, you get a tax deduction. Okay.
And that tax deduction is based on the income that you are making at the time of contribution.
Mm-hmm. So that's something to remember, right? When the theory around RSPs is putting money in when you're in the highest tax bracket, right? So you get the best tax deduction. Then you can get that money working harder in there, okay? So you can have that in a bunch of different types of investments. Then when you pull money out later on in retirement, your income level should be lowered because now you're retired. Okay, so you want to make sure where your tax bracket has come down, so that when you pull the money out and you get taxed on that money, you're not paying as much tax on that money as if you were to pull it out when you were at your high tax bracket. Does that make sense?
Absolutely.
Fantastic. You can also use it, though, for something called your first home buyer's plan. Okay, so what does that mean?
Essentially what that means is that if you are considered a first-time home buyers, and definitely look into that if you're looking to buy a second home many years down the road, but essentially you can access the money you've saved in your RRSP tax-free to use as a down payment on your home. And the great thing about that, obviously you don't pay any tax. However, you are expected to pay that money back over the course of the next 15 years. So obviously if you're taking $5,000, that payback is going to be usually a little bit quicker or very low payments. But if you're taking out, say, $60,000 or $100,000 for a down payment, then you'll be expected to pay back a little bit more every single year until you've reached that limit again.
Yeah, it's such a great vehicle, I think, for a lot of young people, that you can get the tax deduction for putting a bunch of money in and get savings. You can pull it out tax-free for your house, then just put money back in, right? Mm-hmm. It's a great vehicle to fund your first home, okay? A reminder for the registered accounts that they do have limits on how much you can put in. So the tax-free savings account, again, is based on how long you've been around, how much you put in, okay? Mm-hmm. And then also the RRSP is based on your tax assessment. So they'll usually say in your tax assessment how much you're able to put in, okay? So keep an eye on that. You don't want to overfund these things. Last area is something called a non-registered account. So now this is not registered through the government per se, so there's no really, the rules are a little different, if you will, okay? There's typically not a contribution limit. Mm-hmm. There can be a tax deduction depending on how it's set up, but essentially it's based on a different type of tax, something called capital gains tax, okay? What does that mean? It means if your funds did well and you made money on your money, the money you made needs to be taxed, okay? It's like your asset has grown. The opposite is also true. If you lose money, you can also deduct that from your taxes, saying I have a capital loss. Essentially, I lost money on my investments. So those both can be on your taxes, okay? Now, when it comes to the different things that you can put inside of these investments. So if you think about it, you have what we would say a vehicle is each one of these. So the tax-free savings account is a certain vehicle, RSP is a different vehicle, and the non-registered is another vehicle. They all come with their different abilities, right? If one's more like a Ferrari, you can't put a family's worth of groceries in a Ferrari. So they all have different types of, restrictions. So what can we put inside of each one of these?
Well, the cool thing is regardless of the vehicle, you can put different types of investments in them. Mm-hmm. So whether you choose to go with something extremely conservative like GICs, you want maybe a little more play with it, so you do some self-directed where you pick and choose the funds that you have. You can choose mutual funds or seg funds, which are essentially portfolios of different investments put together for you, and ETFs.
Yeah, and there's obviously a lot of different things you can do inside of them. Now let's just use an example, just so people get an idea of what that means. So a lot of people think a tax-free savings account, because typically we go into the bank or a financial institution and we just get a savings account or a tax-free savings account, and we think that that's all we can get in it, right? We just think it's a standard account. No, it's an investment account, right? So let's just hypothetically, this is not for everybody, but let's just say you were interested in Apple stock or Tesla stock.
Yep.
Okay. And that's something that's risky, that has potential to have really good growth over the years. So you can put one of those inside of a tax-free savings account. Mm-hmm. Okay. Again, hypothetically, let's just make up some numbers here. You put in $1,000 and you buy some Apple stocks inside your tax-free savings account. Let's say over the next 20 years, that $1,000 grown to $100,000, right? who knows if that's even true. I'm just saying, how great would that be, right?
That'd be great.
When you don't have to pay any taxes, because since you've only put in $1,000, you're in your limits. It has grown fantastically to 100,000. Then when you pull that 100,000 out, you pay no taxes on it. So you didn't pay taxes on the growth, you didn't pay taxes on the way out or the way in. Yep. It's just an amazing vehicle if used properly. So remember, those three that we talked about, RSPs, non-registered TFSAs, are your vehicles. Everything that you put inside of it is like your gas, your oil, that kind of stuff.
Absolutely. And obviously there are so many different accounts, and for each individual person, it's really going to vary based on each person's needs of which account's going to be best for them. So do some research yourself. I always recommend doing a little bit of research, becoming a little bit more familiar with some of the terms and different accounts available. But sit down with your accountant, find out where the best areas based on your income, current situation is to start investing, and sit down with a financial broker, someone who can help explain the concepts a little bit more and help you come to a more educated decision on which one's best for you.
100%. And choice, right? I think in this world right now, we have more choice than ever before. Don't limit yourself to just what one institute is offering you. Do a little bit of research, find out what you like, and then find the places that fit in with that. Okay. So when it comes to choosing what to invest in, we get this as well. You don't know how many phone calls I get about, should I invest in this? Should I invest in this? And should I invest in this? So there's a lot of different things. Things I tell people to focus on or to look at. What kind of management do you like with a fund or with your investments? Do you like somebody that's going to do it for you? Right, so that you can just go on living your day and that person's going to do all the changes for you. And somebody called a fund manager, right? They're going to manage that fund while you're going to work, taking care of the family, right? You're just want your money to grow. Is it something like self-directed? Are you interested in actually doing the trades yourself, right? Looking at the markets, researching those companies, right? Figuring out what the media is saying, because media has a huge effect on how the markets react, especially right now with social media and the news, and the transfer of information is so drastic that can affect the market very instantly. So are you one person that loves that kind of stuff and wants to manage your own funds? And then lastly, something called automated. So there's a lot of different programs out there right now that almost have a computer that looks at the market and then makes decisions based on what it thinks is the best choice. Obviously, there's pros and cons to all these. You need to find out where you're comfortable in. That may be talking to somebody who's done it before, a professional, right? There's fees associated to each one of these, so figure out what's best for you.
And speaking of fees, I think one of the biggest misconceptions that we see is there's so much negativity around fees. You know, someone will say, oh, well, I switched my bank account because I have less fees, or I don't want to invest in this particular thing because there are fees. But something that's important to note, say for in the example of having a professional money manager, you are going to pay a fee to have a professional manage your money. But typically what we see is that fee that you pay is minimal compared to the potential gain that you have of making by having a trusted advisor, you know, looking at those numbers and making those changes too. Other than fees, there's returns. So taking a look at how things are performing, obviously based on risk tolerance, choosing funds that have long-term return history is really important. That way you kind of have an idea of how these funds are going to perform, how they're managed, and then inflation. You want to chat about inflation?
Yeah, inflation is one of those little hidden ghosts, right? The thing that's working in the background, but is drastically changing the way your money reacts or how it can be used. So let's just take another example, because I'm a very visual person, so this helps me explain it to people. But remember back in the day, your like grandparents, right, or your parents bought a home, right, that was like $30,000, and that was a good family-sized home. Now, if you were to sell that market, right, 20, 30, 40, 50 years later, that same home will probably sell for anywhere between $250,000 to $350,000, depending on if they did upgrades to it over time. But that's inflation, okay? Things get more expensive over time, but your buying power decreases. right? The same 30,000, if you just put it under your mattress, right, would not buy the same home 20, 30, 40 years later, okay? So your money is getting devalued. You can buy less for the same amount of money. So we need to make sure our money is at least keeping up with inflation, and then above that so that we can actually start growing our money, right? Typically are anywhere from 1 to 3% is what inflation grows at, somewhere in there, depending on the year. So making sure your money is at least surpassing that amount.
And then I know we touched on it a little bit in the beginning, talking about risk as it relates to your timeline. Like Jason said, for someone who's quite a bit younger, you can take on more risk in your younger years because you have more time to wait for markets to, ebb and flow and for them to recover. And that being said, as your timeline shrinks, as we get closer to our retirement goals, it's important that we mitigate the risk and take on, less of it. Because as you reach closer to retirement and you start counting down those years, the last thing you want is to be a year out from retirement, your markets crash because you're in high risk things, and all of a sudden you may need to work an extra year, 2 or more. So it's important to decrease your risk as you get older so that you can count on that money being there when you need it.
Yeah, balancing your portfolio is really important, right? If you're just starting in the investment game, are you going to go in super risky? Probably not, because you want to build some sort of base portfolio first, build your money to start with, and then you can start diversifying or taking portions of your money and then reaching out into other areas for investment. So I'm a big fan of diversification. I think putting your eggs in many baskets is a smart thing to do. And then you're ready for opportunity when it shows up, right? If there's a great business or a great property to buy and you've been smart with your money and how it's been managed up to that point, this is how rich people become richer, right? It's not luck, right? It's preparation and opportunity, okay? Being ready for something when it is available. Okay?
I love that.
Such a good advice. I think this was a great basics to start. If you guys have more questions about investing or planning, please send us a message. Comment down below. Obviously, there's lots of things you can do. There's people who love certain things. There's people who hate certain things. But we're all in the same game, right? We all want to make sure that we're making our money perform better. And if we can help you do that or give you some resources to look at or to educate yourself, then that's even better, okay? Lastly, and as always, we're still running our Team Castro Universe Foundation. This is where you nominate someone special to you, somebody that's helped you a lot, maybe it's given back to you or given back to others, or somebody maybe that is struggling, especially through 2020, 2021 now. If they're struggling, then this is a way we can give back. Down below, there's a link. You can nominate somebody that's special to you. Tell us why they deserve that $100. We're giving $100 away every single month for the whole year. It's awesome. We're hoping to get even more backing into it to help even make it bigger and more exciting, and we can do more money or some spa gifts or anything like that. I think it's going to be great. I'm just excited about it.
It's going to be awesome. Absolutely.
And then obviously, if you loved what you've seen, like the video. If you think somebody needs to hear it, share the video. And if you just love listening to Lynda's voice, hit subscribe so you can hear it every single Friday. We're going to be releasing a brand new video to bring you guys a wide variety of topics, things that we're excited about, some stuff that we've learned along the way. Again, it's our opinion. It's what we think is going to be helpful for you guys. If there's something you want to hear, let us know. We'd love to do that. Or want to work with us or want us to come speak at your events or whatever, let us know. We'll talk to you soon, guys. Have a great day.
See ya. Bye.